Welcome, dear viewers, to the fifth talk of our YouTube series being held from 10th to 16th October as part of the World Investor Week. Harmony Talks is bringing this session to you in collaboration with our partner, BSC Investor Protection Fund. World Investor Week, an initiative by the International Organization of Securities Commissions, is a global investor awareness campaign that witnesses a host of investor awareness activities. In India, it is conducted under the auspices of the market regulator SEBI. As a part of this, Harmony Talks, in collaboration with BSC Investor Protection Fund, has put together a series of fireside chats with industry leaders, a YouTube talk series, financial literacy sessions, and the like. Today, I am pleased to introduce to you our speaker for the day, Mr. Prateek Pant, Chief Business Officer at White Oak Capital Management. Prateek has over 25 years of experience in banking and financial services in India and the Middle East. Prior to White Oak, he was the head of products and solutions at Sanctum Wealth Management, and in fact was also a part of the founding management team. In his prior experience, he has worked with uh, organizations such as RBS Group, Franklin Templeton, Bank of America, ABN AMRO Bank, HSBC, and Commercial Bank of Qatar in the domains of branch banking, credit cards, asset and wealth management. Welcome, Prateek.
Thanks a lot, Heman. Thanks for having me here.
Sure. It's our pleasure to have you as well, Prateek. So today's topic, as we know, is advantages of NFO and outlook for NFO investors. We have chosen this topic as it's not an often discussed topic. So to set the tone for this conversation and to help our viewers understand some basic terminologies, let us come to the basics first.
Sure.
For the benefit of our viewers, could you please explain what a new fund offer or a NFO is, how it works, what are open-ended, closed-ended funds, what is NAV or net asset value, and then we'll take it from there.
Sure, Heman. So as you already mentioned, NFO is a more common parlance, which actually is a new fund offer, right? A lot of times people confuse NFO to an IPO, which is an initial public offer where companies offer fresh capital for subscription for companies wanting to list on the stock exchange. NFO is a term which is primarily used within the mutual fund industry when a mutual fund company is actually launching a new scheme for first subscription, right? And what happens typically during that point of time, that it could be, today there are 44 asset management companies in India. The asset management company is also a mutual fund, basically, right? They have mutual funds, and mutual funds could have multiple schemes within equity, debt, hybrid, multi-asset allocation schemes, gold schemes. So, there could be different categories of schemes. The first time a scheme is being offered to a subscription, the subscription happens through the NFO or new fund offer, which is there. Now, there, as you rightly mentioned, there is an open-ended fund and there's a closed-ended fund. Today, I would say most of the subscription actually happens through open-ended funds. The open-ended fund is something which can be bought and sold at any point of time, right? While typically the closed-ended fund opens for subscription only during a NFO period. And after that, if somebody has to buy or sell, it happens through a stock exchange. Now, NAV is again nothing but a net asset value, which is the value of the fund after it is listed or open for subscription, right? So typically NAVs are 10 rupees when they are offered for the first time. And depending on what the underlying portfolio is over a period of time, the NAV could go up or down as per what the holdings of a mutual fund company is. So that's a brief background about it, and we can of course talk about many more salient features of what is really there within this category.
Sure, Prateek. So as long as we're talking about the basics, could you also tell us, help our viewers understand what happens post NFO, that is once a new fund is launched, what happens in terms of the liquidity of the fund, liquidity for the investors, and the NAV, by if you can contrast and compare the open-ended versus the closed-ended funds.
Sure. So I think what happens, is that post NFO, in case of open-ended funds, as I said, they're typically, you've subscribed at 10 rupees, and once they are open for subscription, you could buy on a daily basis on the applicable NAV, of course, subject to the prevailing, exit load, which could be there. So for open-ended fund, there is no real limit on the number of units a scheme can offer. So it basically means that the investor who's there is coming to a mutual fund company and can subscribe to as many units at the prevalent NAV which is there, right? And it is the fund house which is actually creating liquidity to buy and sell, at the fund house level itself, right? So whenever a subscriber is buying a unit in an open-ended fund, right, the scheme actually creates new units, right? So there are no new units. So assume during the NFO, a fund house collected 1,000 crores, right? And then investors are coming in and subscribing to new units. So you could create another 100 crores of units, and 1,000 will become 1,100 crores as the corpus of the fund, right? In case of a closed-ended fund, it's a little bit different, right? In closed-ended fund, the units are typically only traded on the stock exchange. So once you close the NFO, you can't really have a follow-on issue or an issue where you are going to create new units at the subscriber level. So somebody has to sell for someone to buy, right? And that liquidity typically happens through a stock exchange. Investors cannot buy directly from mutual funds, and no additional units are really created in case of a closed-ended fund.
Sure. That explains a lot about the differences between what happens in a closed versus an open-ended. There's also there's a hybrid of these two called the interval funds. So a quick note on that as well.
Sorry, I didn't hear that.
There's also the hybrid of these two called the interval fund, right, which has a transaction period versus a interval period. So a quick note on that as well.
Yeah. So it, as the message is, the interval funds are typically available at a certain interval, right, for subscription, right? And investors would come in at that particular period, to really subscribe to these units.
Sure. So let's move on from that, and let's get into a little bit of nuance, some nitty-gritties, which probably will help our investors, our community members, try to assess NFOs in certain ways. So for the benefit of our viewers, again, can you also throw some light on some rules like the 2025 rule for NFOs? What does it mean? And the SEBI requirements for mutual fund itself to invest in its own scheme. Earlier it was 1% of the corpus raised, or 50 lakhs, which was lower. Has this changed, and by to how much? And importantly, is this something that investors can use this information in not only deciding which NFO to invest in, but also forming an opinion on how safe the investment is, or how good the performance of the fund may be after they invest?
Sure, Hemant. So, the 2025 rule is a fairly is an old rule which SEBI's had. Again, more from the perspective of being able to protect the investors, right, and ensuring that certain investors cannot come and influence the outcome of the, because the mutual fund is a collective investment vehicle, right, where number of investors have to come together, and the rights for each investor should be same, and no one particular investor really dictates what happens in the particular scheme. So a 2025 rule specifies that any mutual fund scheme should have minimum of 20 investors, and no single investor can really account for more than 25% of the assets which are managed by that scheme. Now, this reporting has to be done on a quarterly basis, and if somebody is not adhering to this, then there is, you're given 1 quarter to adhere to this and ensure. Otherwise, there is a SEBI warning letter which gets issued for any of these type of schemes. Finally, if it doesn't happen, then the schemes actually have to wind down, right? There's also a rule which says that typically when you have an equity scheme, you should collect minimum 10 crores during an NFO, while within a debt scheme, you should have minimum 20 crores. Again, so that there is a certain optimum size of the scheme which is there. The rule about 1% 50 lakhs is changed right now. It was more around skin in the game, right? Which is what SEBI has been emphasizing. There was a recent circular where, depending on the risk rating of the scheme. So what SEBI's done is every scheme has to be categorized into a certain risk bucket, right? Where a risk value of 1 indicates low risk, right? Which is typically invested in some of the AAA type of corporate securities or, Government of India securities. And a rating of 5 is a high risk, which is pure equity schemes, sectoral funds or things like that. So typically, again, this is for every AMC, you need to be investing anywhere between 3 basis to 0.13% of the AUM. So the AMC has to invest its own money into these schemes, more from a skin of the game perspective, right? So that type of seed capital should be provided at any point of time by the AMC in the scheme. You would find, a lot of times, Hemant, and we ourselves at White Oak have done that. We are significantly more invested than what is required, which also shows the confidence of the managers. There are other things which have been done where, all key management personnel in the fund have to invest on a monthly basis 20% of their compensation into their schemes itself, right? So there are many of these parameters where the regulator have put in place to ensure that not just at an asset management company level, but even at individual levels of people who are working in the asset management company, there is a lot of skin in the game, which is there at any point of time.
Sure, Pradeep. So that sounds really good. That one, the regulator has put in a lot of checks and balances, and two, that the industry also is kind of not only just adhering or complying, but going beyond that. So I think that's a very healthy sign for investors in general, not with respect to just NFOs, but in general. Now, continuing with the theme of how investors can further assess mutual fund NFOs. Now, given that an NFO is by definition a new fund, it's newly launched to the market, there's no past precedent, right, by which to gauge the scheme's performance. So in such a situation, how can NFO investors assess the returns potential of the scheme? How do they know that they're placing their money on a good bet? What kind of information in the fund's scheme documents can investor refer to gauge this?
Yeah. So the holy grail for an investor is really SID or scheme information document, right? I mean, everyone, normally there are a lot of pages out there and people don't even go to look through that, but it's a very important document, Hemant. The SID typically talks about the objectives of the fund, the type of asset allocation which will be there, what type of instruments will be used, the investment strategy, what is the investment team which is there in place, right? So all relevant and pertinent information which is required to make a preliminary assessment of what is this particular scheme is actually available in the scheme information document or the SID. Typically, things like investment strategy, risk management forms, all of these are integral part of these particular documents which are there. So for a new fund offer, right, there are, in my mind, when you are doing that assessment, you have to understand whether after you've done a diligence on the SID, does it really adhere to what your own risks and objectives as an investor are, right? So for example, if you have a low risk tolerance, would you want to invest into a scheme which would invest 65 to 100% in equity, right? Or if you're looking at intermittent cash flows from time to time, would you prefer to be in a hybrid scheme, or would you be in a 100% debt scheme? So, some of these type of, questions are something where the SID has to be matched with your own assessment of your objectives and risk budgets and liquidity requirements, which could be there. And then be able to marry that. Now, how do you assess the quality of the issuance, right? So in that, I think you have to definitely, be able to do an assessment of the background of the asset management company, right? Who are the promoters? Who are the sponsors? What is the quality of the investment team? What is the quality of the services which they would be able to provide? The philosophy, the processes, is it flash in the pan? Normally we say past performance is no indicator of future return. So that's where, while you of course do look at financial parameters and understand what is the existing track record of the fund, but is there capability to replicate that going forward? And that is where understanding some of these risk functions, investment processes, philosophies, and portfolio construction, right, becomes quite important to make that level of assessment. So those are the things you would really need to marry, right? The quality of the investment manager and your own objectives in life. And when you do that level of assessment, you will be able to understand whether is that the right fund offering in your overall portfolio allocation which you're looking at.
Sure, Pratik. So I think that was a very lucid and a really comprehensive information that you have given. And I hope I encourage our viewers to kind of note this down as some kind of very important information to kind of do some due diligence on before investing. And to just add on a little bit about what Pratik mentioned as the scheme information document, there are also other documents called the statement of additional information. There's a key information memorandum, which is a kind of a concise compilation of the SID and the SAI. So at least if not the SID, I think Pratik, you will agree that at least the KIM, key information memorandum, should be something that all investors should definitely go through before even looking at investing in a fund.
Absolutely.
So, yeah, so that's actually very comprehensive information. Thank you, Pratik. We'll move on to the next question. Now coming to the aggregate scenario, right? The uptake of the interest that we have seen in NFOs, or the lack of it, whichever way you view it. I think this year probably we are seeing around 20 to 30 NFOs launched every month, if I'm not mistaken. What kind of investment volumes in INR terms have we seen in the past with respect to NFOs? Mm-hmm. And the second part of this is, do you feel NFOs have been able to generate that kind of a buzz, which IPOs seem to have done we talked about IPOs in the beginning, right? So have NFOs generated that kind of a buzz? And if not, why not?
Sure. So I'd actually done some compilation on this, Eamon. We've seen 49 NFOs so far launched in this period of April to August, and roughly anywhere between 12.5 to 13,000 crores, which have been mopped up. So roughly about 250 odd crores per NFO is an average which would have happened during this last, 5 to 6 months, which is there. In fact, there was a period in the middle for 1 quarter, there were no NFOs because the industry had to comply with certain regulations which SEBI had asked. And because of that, there was a little bit of bunching up, which you did see, during a certain couple of months period. And now it's been more or less, steady state is what one would say. What we're seeing is there are 2 categories where we've seen NFOs come in. There are a lot of new AMCs, including White Oak, right, which have recently set up we've recently launched our offerings in the market. So some of the new AMCs are actually trying to fill in the product gaps which are there within their offering. So that is one particular thing. And second has been that there is a lot of interest which people have seen on the passives side, right? ETFs, which are being launched of different categories, different types of ETFs, which have not been available for Indian investors. So it's not just investing in indices, but you've also seen some factor investments, you've seen some theme investments, and some unique ideas which have been there within the whole ETF space. And I think those are the 2 categories you've seen a lot of things coming in, besides some of the more BAU things which on the fixed income side, which have been more, as interest rates are moving up, it's becoming quite attractive for people to lock in money at higher rates. And to that extent, you're seeing some of the target maturity funds, which have also been launched in recent times. So that's really where you're seeing the NFOs. But, the NFO and IPO is very different, right? Typically, what happens is that in IPO, there's still, as I said, IPOs are typically new initial public offerings by companies which are looking to list in either the NSE or the BSE, and in most of the times, it's a new issuance which is there from companies, and there is an element of undiscovered price element which is there in an IPO, right? It could be a new, something happening in the EV space, something happening in retail space, something happening in technology space for these IPOs companies. And to that extent, there is a lot more buzz which gets created of a certain company in a new sector, in a new market type of a thing. And you could, investors may expect gap up listing in an IPO, right? A subscription came in for IPO price 250, the issuance opens at 300, 350, oversubscribed 200, 300 times. So you see that demand supply gap. As I said, in a NFO, there's no typical target, right? You've said internally, you may have thought you collect 500 crores, you go and collect 2000 crores. You have a market out there to deploy, and there's no gap up listing, because the NAV in case of an NFO is 10 rupees, and it'll open at maybe 10.1 or 10.2 if the market has moved up and the underlying securities have moved up in that point of time. So it's not right to compare an NFO with an IPO. These are completely two different things. There is a lot of upside or downside which can happen in an IPO. Typically, an NFO will, the opening will be in a plus minus 1-2% range when the units are available for for subscription after an IPO, after an NFO has closed and open for subscription.
Thanks, Pratik. I am sure I'm glad that we got that clarity between IPO and NFO, because a lot of investors tend to kind of weigh them in the same balance in terms of how to view the prospects of post NFO or post IPO. Now, coming to the product itself, the NFO, what do you feel is the biggest advantage of an NFO from an investor perspective? And again, to balance that, what would be the biggest disadvantage from an investor perspective?
Right. So let me start with the disadvantages before advantages. So typically what happens in a disadvantage is that because this is a new issuance, a new scheme which is coming through, it really doesn't have a track record. So you don't really know the past performance of the fund. You don't at times know the details of what the for a new fund house. At times you don't have track records. You don't even have the pedigree of the investment team, which is available in the public domain. So some of those type of issuances can have challenges. Understanding also the what could be the expense ratio, because the expense ratio is a function of the collection which is there. So those are all indeterminate factors when you actually go in for an NFO. The advantages is that at times you've heard about a new asset. You've heard about an asset. An investment manager who could have been there only in the private space or open for certain categories of investors. This actually allows a retail investor to come in with a minimum application of 5,000 rupees and take part in the same platform which was maybe available for a certain other private group of investors or category of investors where you had a much higher ticket size which was required. Also, what we've seen is as a portfolio is getting constructed with a smaller fund size, the flexibility which some of the fund managers have to be able to work on the portfolio during the initial period tends to be a lot more. Although it's not a rule, but it does happen at points of time, right? It can play both sides at times, but good quality fund managers are able to deploy a lot more, let's say, actively in a smaller fund than what they'd be able to do if it's a 10,000, 20,000 crore fund, right? So those could be the advantages for a fund house which is coming in with a smaller corpus right now, rather than a bigger corpus where the impact costs and all could be very different.
Okay, great. So moving on, your quick thoughts on starting an SIP for an NFO, just like we do it for mutual funds.
Sure. So SIP is I think the the three-letter golden word in the industry. Recent data, if you see, which has come out, we've had, despite where the markets are, 13 to 14,000 crores of SIPs are coming in month-on-month basis. I think it's the biggest revolution in the mutual fund industry we've seen. SIP is something which helps in longer-term wealth creation. The true, as they say, right, the eighth wonder of the world is compounding. The true compounding happens through SIP. So I would say, when you get in at 10 rupees right at the initial stage and see your, are part of the journey of a good quality NFO, as it goes through a 10-year, 20-year, 30-year tenure. There have been a lot of studies saying that there are not many investors who have, while the fund NAV has grown X number of times, number of investors who've been able to take advantage of that compounding is a fraction of that. So that is what I would say. I wouldn't, let me put it this way. There is no real advantages or disadvantages of coming in during a NFO for an SIP. SIP at any point of time in a good quality fund, whether it is an NFO or it's an ongoing scheme, is what is the most important thing.
Sure, Pratik, that makes a lot of sense. So as we close the session, just quick look ahead in terms of, do you see renewed interest coming in for NFOs? And the second part of that is, or on the other side, is it a game of wait and watch to see if the NFOs are the category of investment really hit it big time?
I don't think that is true. Even, I mean, it's not, as I said, right? NFOs are a vehicle for asset management companies where there are gap in their product offering, right? The investor should still look at his own risk appetite and his objectives when he makes that assessment, whether he would want to be with a new, on a new offering, or would rather put in money into the existing products or offerings which are there. So in my mind, it's more a vehicle for asset management companies to launch new schemes, and it's not something where there is a trend around NFOs. Gaps where they will exist, will continue to see offering coming in from asset management companies, and investors should take a more judicious stock of their own gaps while making that call. So it's not about investing in NFOs or not investing in NFOs. It's about investing in good quality schemes with good quality managers, which fulfill your own requirement, which is the most important thing.
Sure, Pratik. So I'm sure our viewers understand that it's not about going with the herd, getting in with a fad of investment. It's more about matching the your risk appetite, the gap in your portfolios to what's coming, maybe as an NFO or as its existing fund. So really helpful insights, Pratik, coming from you. Thanks a lot. It's been a pleasure to have you on this fifth installment of our YouTube series as part of the World Investor Week. I am sure all our viewers and our entire small investor community at Hermit Talks have found it really valuable advice coming from you. Thank you, Pratik. And yeah.
Thank you. I mean, you're doing an amazing work of reaching out and educating investors. My only advice always to investors is just remember, it's not about timing markets. The time you spend in the market, harness the eighth wonder of the world, power of compounding, because that is what is the sense and the discipline of true wealth creation. India is a great story, and if we believe in that story, right, the asset class will help you create that wealth, provided you are there for the longer period out there. But thanks, and again, amazing work which you all are doing.
Thank you, Pratik, and very reassuring words, very solid advice coming from you for all our investors and our viewers. To all our viewers watching, thank you for joining us in this fifth talk of our YouTube series, which is being held as part of the World Investor Week from 10th to 16th of October. Thank you all.